What if we really have seen the top in rates just as tech earnings are about to roll in? Could it be enough to get stocks back on track towards a year-end rally? Let's ask AJ Oden, JPMorgan's global investment strategist, with me here at Post 9. It's good to see you. Welcome back.
Good seeing you too, Scott.
It is an interesting market move today. What do you make of it?
Well, I think, when we saw rates almost touch that 5% mark, I mean, they were basically at a buy at 4%, but 5% just becomes that point where you got to lean in now. And so, hearing that institutional investors are starting to lean in and add duration, it only makes sense for the rest of the market to start to make that move as well. And maybe we saw too much of a sell for some of the geopolitical tensions that we've seen over the last couple of weeks that have brought the market down a bit.
That's pretty much Ackman's point. We can show his tweet, of course, which happened, earlier today and really did have an impact on the market. Just too much risk. There's too much risk, he says, in the world to remain short bonds at current long-term rates. The economy is slowing faster than recent data suggests. So he covers a short. What does it mean, though, for now, for the market itself, for stocks? If he's right, if we assume that rates have peaked, what's it mean?
I think it means that investors should start to add in duration now. They've been waiting for that moment for rates to fall or for the market to sort of give them that point where they need to move out of rolling T-bills or those cash positions and start adding duration. So to me, this is that moment, and they should actually take that opportunity to move in. Now, I understand that growth expectations are still pretty high. We've got GDP expected to come out later this week, and expectations of above 4% on a quarter-over-quarter basis or year-over-year basis. So that, to me, that's probably one reason why yields have been up on top of all the other things that we've been talking about. But I think clients or investors need to stop trying to time the market and lean in now, because it's going to be a bottleneck when it actually starts to move. It's going to move pretty quickly.
Now, before rates really started to shoot higher, before we got above 5%, the narrative seemed to be, well, we might be primed for a late year rally. Like, seasonality's back on our side after being tough in September, and the table seems to be set. Is it still set? How do you view equities now?
So earnings have been a bit muted, I think, so far at this point. There's a little bit of disappointments in the regional and the healthcare space. But it's still early in the game, right? We've still got the big tech names the rest of this week, and we're still optimistic that we've seen the trough. Those last 3 quarters were probably the last 3 negative quarters, at least in this cycle, that we'll see, and hopefully we'll get that positive back. I know the market has moved away, and now is expecting, I think, about 0.4% contraction, but we believe that we're still going to see a positive earnings, and so from there you should see a tailwind, and that soft landing is still very much in play, even though we've seen some economic data that may have spooked investors a little bit. We expected volatility, and that's what we should expect from a couple data points, or just a few data points.
Well, I just want to underscore what we're watching on the screen here. I mean, the 10-year note yield down 17 basis points today, right? I mean, it was a smidge over 5%, and then, it pulls back. Let's assume that, rates back off instead of back up, right? They back off a bit, and tech earnings this week come in as expected, if not better than expected. Is that enough? If you just wrap your arms around that, is it enough to get stocks to where the bulls want them to go over the next, 2 months?
Oh, I think definitely. I think if rates start to come down, then the bulls definitely lean in, and that's why we're telling clients, you take advantage of both sides of this equation. The 60-40 portfolio has never looked this attractive. We actually took advantage of looking at it from a real yield perspective, and what we've seen since 2010, real yielding at 5.5%. If you go forward about 12 months, on average, you get about a total return of about 18%. And right now, it's flashing around 5.6% from a real yield perspective. So we're telling clients to lean in. So take the opportunity on this entry point bonds, but also take that opportunity in equities right now. So I think they should both lean in on both sides.